Laurence asks a simple question. It's not a simple question. It's a very simply phrased question, but it's complex to answer. Laurence asks, what is the best earnings strategy? For me, for what I've tested, from what Ernie's tested and what Ernie's been doing, it's long straddles. It really is. Okay. We had a webinar a few weeks ago, maybe a month ago, where we sort of talked about and compared the earnings strategies concepts. And Ernie's been testing and working with the long straddle concept for a few years now. And it's not that he's just testing the long straddle concept. It's that he's comparing it to short strangles, butterflies, long and short butterflies. Okay. And he's found, and even the other more elaborate concepts of buying a call or a put or straddle or strangle, Laurence, 5 weeks before earnings, hoping that you get an implied volatility increase and your options swell, and then you sell them before even the earnings. He tested that too. Found it didn't work as well as what he was testing. All right. So there's a lot of ideas out there. We've covered a lot of this in various webinars. A long straddle is simply buying a call and a put at the same strike price, okay, and same expiration. What Ernie's been doing, what we've considered, is using shorter term options that have less time decay. So if I have earnings coming out next Wednesday on a stock I'm interested in, if the stock offers weekly options, I'm probably buying next week's Friday expiration. The immediate argument occurs is that we're paying too much into implied volatility with this strategy. We're going to get hurt by the implied volatility crush. That is true. But Ernie found that with the movement of the stocks you consistently get and the cheaper price of the nearer term options, it balances out over time and performs better than reversing this and trying to sell into high implied volatility, where occasionally you get crushed with that one stock that moves up 15% or the one stock that falls down 25%. You're destroyed. You've probably wiped out 30 previous trades trying to sell into earnings. Okay? Now, this is an idea. This is what I know has been tested. And this is what I know that Ernie has shown, and he's shown his success rate to me, and I've seen some of the tests where it didn't work as well. There are a million different ways to play earnings, and I'm going to scroll down to the bottom because I have a feeling 2 or 3 of our regular attendees have commented in on them, and it's perfect right here. Yes, long straddles, Laurence. Sam offers his thought. He says straddles, but they're pricey before earnings. What Sam usually tends to do is go trade anyway, with or without the thought of earnings sometimes, but maybe doing a straddle or strangles that's 2 to 3 months out in time, but he's actively managing them. All right, so I'd be buying a November straddle or strangle, most likely a strangle in my case. I'd be buying a November strangle, say on Apple, but as the stock moves up, I'm going to make adjustments to the call and the put. Sell premium against it to create a different type of spread. That's a little bit more elaborate what Sam's talking about. It's not directly an earnings play, but it can be. Okay, and initially preferred to go further on time. What I'm doing now is I got to add the custom spread tool back in. Okay, now what am I talking about? Let me go back to the home page very quickly. Let's just take a good example. All right, so one of our pods, of course, here, ex-dividend stay. Oh, I don't have it added. Okay, so oh, it's got to be there. I'm just missing it. Market activity, power pull, stock gainers, stock losers. Is it all the way? It is. All right, so here's the listing of earnings announced today. We saw Deere did well, a couple of others. I'm going to click on View More Earnings Announcements. This takes us to the earnings page. What have we got coming up in earnings? 828, Palo Alto, Weibo, Toll Brothers, Intuit. Intuit's an interesting one. It's at 322. It's going to be pretty expensive, and that's on. Oh, shoot. I'm sorry. Okay. That was interesting. Let me go back there. It's funny that I saw some weird dates. Oh, 825. That's what I want. I'm sorry. So Ernie actually shows a straddle here for you on this earnings page, a straddle strike percent net debit. So this is what Sam was referring to. Okay. The cost, the debit against this is just one example, but the near-term straddle that Ernie would look at that expires on the 28th, he's showing you here is the 322.5, right at the money. And it's 5.7% of the underlying stock price. So what does that mean? That means you do need 5, 6, 7% move to see a profit on the position. If you get a 2 or 3% move, you might be down 40 or 50% with the volatility crush. But you're also going shorter term for the lower cost. If we went out far in time, like Sam had mentioned, this might be as high as a $30 or $28 straddle or strangle, and that might be okay because you have more time, right? So, Laurence, this is what I'm telling you. You see here is that Ernie's preference is to look at the nearest available expiration. He's looking at the 28th of August if the stock offers weeklies. If it doesn't, he'd be looking in September. You had mentioned, say the earnings is next Thursday. That's what Ernie would be looking for. Okay? Now, this is just a view. I'm going to do it. Add to portfolio. Oh, that's a glitch. Okay, so we're going to do it manually in a second. Let me go back to that. We're going to add manually the Intuit 322.5. There we go, 322.5 for 828. I'll put that in. It'll be about 1850. All right, now I want to go back to the custom spread tool. I'll add it from here. So what does of course this look like? That's what we're talking about with the shorter term, and the implied volatility is probably already factored in, but the implied volatility will also probably gain as we get closer next week to the earnings. So this is the long straddle position. Okay, it does have a wide break even. That's that 5.7% we were talking about. You saw the percentage there as well. Okay, now, excuse me, folks. Some say that it's better to take advantage of the higher implied volatility and to sell into this position. Well, now you've got a naked call and a naked put with an extraordinarily high margin requirement, which is going to crush your potential return. Monetary return is the same as the cost if the stock stays right where it is. Okay, this isn't a good play. What you might want to do is consider a strangle. But then again, I had a discussion with a customer today, briefly on the phone. Let me build a strangle for you on INTU for August 28th expiration. Stock's at 322, so I want to go almost 10% out of the money for good protection. So we're talking 30 points out of the money. I'm going to a 295 put, and let's just say the 350 call. Not the same range apart, but let's just do it. But see, look, here's the problem now. Premiums are fairly low, but I'm trying to give myself that cushion of 10%. Okay, this is a short strangle, not what I would do around earnings. Okay, it gives you a wide breadth. You know, even with earnings coming up, though, the premiums are extraordinarily low. I'd consider this low. On the margin requirements, only a 0.3% return. That doesn't look too good. If the stock drops 15%, you're down $1,300, $1,400, $1,500 when you're originally expecting a max return of 220. That doesn't look good. Customer asked me about doing shorter term iron condors on stocks with earnings. Well, what's the iron condor going to do? Well, that's when you add an extra wing on the outside, so you have a capped gain and you don't have this high margin. But now you're talking about less premium, a potentially higher return because you might only have a 5 or 10 point margin requirement on it. But see, I'm still going 10% out of the money. A stock that falls 15%, I'm now losing close to 100%. If it rises 15% or falls 15%, I'm losing close to 100% of what I invested in the position. Even with high volatility, the premiums aren't high enough, and you take one loss. That's the problem. You take one loss with this smaller premium involved of a 5-point or 10-point spread, you're wiping out 5 to 10 previous trades on the position. Okay? So that's why I don't sell near term. Now, we can go over many, many different ideas. And yeah, we're already at 5 o'clock. I'll go over one other idea. There's multiple ways to play this, okay? No, Ernie, okay, so David, let me go over this again. Some of this information can be seen, by the way, that I'm talking about. You go into the long straddle, go into introduction to straddles. Ernie starts talking about it then. Starts talking about it there, David. My apologies. David's question was, do you exit straddle the day after earnings are announced? Yeah, usually that's when Ernie exits it, so not lose the rest of the time decay. Do you put the straddle on the day before? No, it's usually about 7 to 10 days before, I believe. 7 to 5 days before, I think is what Ernie's been doing. But you can do it differently depending on your outlook as well. All right. So let me go back to the custom spread. I can't remember who brought this up. Fernando has another question there. He asked me something similar to this months ago, and another gentleman, I can't remember if it was Larry, not Laurence, or if it was Jim S., but asked about going 3 weeks before earnings and trading a calendar spread. So back around August, last expiration, August 14th, I might have bought an August 28th, let's say 317.5 call. I don't know where the stock was, so I'm going to put the price a little higher, maybe at 12. Okay, let's say it was saying the same price. Put it at 12. And then they were going to sell a call for the week prior to expiration. Naturally, this only works on weeklies. So they would have sold the 325, which might have been, let's say, $3. Okay, so what's the idea here? This is a diagonal spread in a sense, even though we're using weeklies. It's kind of low. But the idea is that you're trying to get into a call position that is after the earnings event and pay down the cost by selling a call against it. And he might do the same on the put side, creating a double diagonal. So he sort of has a strangle, but he has 1 week in of premium generation before the threat of the earnings hits, where it would be a capped gain, as you can see here on the calendar spread down below. And so that's sort of the reason. That's another way to do it. Another concept, to make it even more confusing, there's this idea of a ratio back spread for earnings. Okay, what is a ratio back spread? A ratio spread is selling twice as many as you're buying, or some combination of 3 to 5. Doesn't always work. But if you can get the right combination, what I might be doing is buying one sort of at the money. Buy two. No, I want to go out of the money. My apologies. In this case, I want to go out of the money because of the prices. Let me clear that call out. Yeah, I want to buy an out of the money, 2 of them. So this is going to put me at $15, and I'm going to sell one in the money for a higher premium. Okay, this is an opposite of a ratio spread. This is the ratio back spread. So I'm selling one in the money, buying 2 out of the money. I'm going to try to do it at a credit. This is only 65 cents. Okay, but here's the idea with this ratio back spread. Interesting that the upper and lower break evens are almost identical to what we had on the straddle. I think it was 340 and 305 was the upper and lower break even of our $18 straddle. This is almost just as close. What's the benefit of this? Well, you still have that unlimited upside if it goes up, but if it craters, you get a small net credit of 65 cents. So it doesn't have the advantage of the long straddle in this case, where you can profit in both directions. But if it falls, you could still have a small credit. That's the ratio back spread. In this case, I wouldn't do it because the break evens are almost the same. I'd better be off in the straddle in case it does drop down to 290. Guess what? I've got profit up here, not 65 cents. But requirements lower. 1,400 versus 1,800 because you took in that small premium and you're not buying a call and a put in high implied volatility. You're hedging the cost of the 2 calls you bought by the one that you sold. But it doesn't give you the potential profit in both directions, only one. Again, this is another idea. Some of our attendees have used this and said they've been successful with it. I don't have the statistics to backtest that as well. So for us, and everyone's opinion is welcome. Sam had talked about the 2 to 3 straddles out there managing. He says, I use my straddles in SPY. 300 calls are still good. 3 months trade, the puts are 0 in my puts premium and got fit. Yeah, so he's actively managing. It's not just sitting on it. Okay. What do you want with the price, Laurence? I can't answer that. Okay, I can't answer that question. I think what Laurence is asking is, what do I want the price to be when I buy it? Well, a good gauge that Ernie uses, he's trying to keep it under 7% of the stock price. Why? Because on average, anything above 7% is good, but you don't see it as often, right? Sometimes you might only see a 3 or 4% movement. You want, in either thing that I'm talking about, the longs, you're going into earnings, Laurence. You want the stock to swing up 7, 8, 9% or swing down 7 or 8, 9%. If your estimation, your expectation for the stock you're interested in trading earnings on is that the stock's not going to move more than 4 or 5% when earnings come out, that is not the time to do a straddle. because if you're paying in 7% net debit, you're going to be at a loss. You'll have a profit on the call, but you paid 7% of the underlying stock price in, you get a 4% movement, you're going to lose. You're going to lose 100% on the put if the stock goes up, and you might only gain 20 or 30% on the call with that small of a move. The long straddles, you would only do those positions if you're expecting a big enough move, say greater than 6 or 7%, to get a leveraged return. All right. If you're expecting a smaller move, you probably do want to do a different strategy. And now you kind of have to guess, are you bullish or bearish? Which direction you think it's going to go? Now, this briefly goes into Mohamed's question. We're talking about earnings. He did leave, but we're recording it, so that's fantastic. Sorry about that, Mohamed. Mohamed says, what is the best strategy to protect stock during earnings? Married put or 2 married puts as well. Okay. Under the married put tool, we've got the insurance tool. So let's say that I'm going into earnings on INTU, but I actually bought it at 285, and I'm going into earnings. So I'm going to look at a short term, let's say September series or August. We'll use August. It'll show me the weeklies. You could use August or September, Mohamed. What this tool does shows me, okay, I've got a 13% unrealized profit in INTU. It shows me the potential puts I could buy that would lock in profit if I'm wrong. So here is not too bad. That 332.5 put slightly in the money from where we are. Cost of 1505. But in this case, if the stock falls, my cost basis is still only 300. I've got a locked in profit of 10.8%. So if the earnings disappoint and the stock craters, I locked in 11% of profit, 75, 70% of what I have right now that I didn't take off the table. But if it moves up, you can still see further upside profit potential. So if you have a stock with an unrealized gain and you're going into earnings, following the married put ideas, the radioactive trading technique, you can use that insurance tool to find positions that can lock in profit and continue up. Another concept is to create on your stock, Mohamed, a synthetic type of straddle. This is one of the income methods discussed in the blueprint for the radioactive trading married put approach. I could go cheap or I could go expensive. We'll go cheap. Let's do the same thing. Let's buy the 322.5 put, which didn't give me as much locked in profit as the 332 we saw. But now I'm going to buy 2. So I've got my 100 shares at 285. I'm going into earnings. It's going to cost me $30. Bulletproof position. Can't lose in this case. Meaning that even if the earnings come out next week on INTU and the stock stays at 322.50, I'm still making a 6% profit. But I've got unlimited profit to the downside and unlimited profit to the upside if it swings. That insurance tool under the married put tab, that is where you want to go as you're going into earnings with your stock if they're not already protected. See which put would give you the most locked in profit. Then link over to the profit and loss chart and see what would happen if you bought 2 of those puts. Does that put you in a can't lose situation on your stock position going into earnings? That's power. That's the power of the radioactive trading techniques and the put option concepts to ensure your stock. Okay? All right. Yeah, those, Laurence says, thanks for that. Too complicated. I'll stick with selling spreads. Yes, but the straddles are still a good approach for earnings. You just pick the at the money one, nearest term expiration, and you could even try to go out to September if you want to, so that'll give you more time to play with the positions and roll them and adjust them. But a simple long straddle is not too complicated. You're just getting in before the earnings, getting out after the earnings, with or without a profit. You can lose. The stock only moves 1 or 2%. Remember, you can lose 80% of what you paid into the position in that case. Okay. All right. I'm going to William next. I'm just seeing if there's any other comments here related. Rex, I'm going to answer this question directly right now. Whether or not, let me just do this. Whether or not I'm buying now or I'm insuring stock. Rex question is, if you had to pick one option strategy was safest and most reliable, what would it be? Married puts. And you said like spreads, iron condor, strangle straddle, something else. Married puts. It's the definition of reliable, but also the safest. It is the safest, Rex. It's the safest thing you can do. The married puts, following the radioactive trading technique, not just simply buying a put that's 30 days out of the money and is low cost, but you're still taking on a 12 or 15% risk, but using the put as a second asset that is bought further out in time, that is slightly in the money on the position, so we can control our risk to 5 or 6% on the trade. So I'll just go into the search here. And am I saying that this is the best strategy to profit long term? Maybe not. Okay, I might get more. I do get more return with my bull put credit spreads, but at times the bull put credit spread portion of my portfolio is down 50 or 60%. That's the nature of spreads, iron condors, strangles, and straddles. That eventually, in wrong market conditions, a slight black swan event, which we've had almost 8 of in the last 18 months, 22 months, Rex, your portfolio is down 50%. My bull puts was raging on before February 5th, 2018, with an insane return over the course of 11 months leading up to that. It was ridiculous, the percentage return I was making. I was averaging 15% on winners, right, 87% of the time. Of course, from 2017 to 2018, it was phenomenal. One day, 4 trades open, February 5th, 2018, start of the Chinese tariff wars. Market fell, volatility spiked. That portfolio was down 49.5%. I closed all 4 positions out within a day. If I left them open, I would have lost 100% of what I had invested in those 4 positions. I had to stop it at 50. I had to stop the bleeding and get out. So, one option strategy, the safest and most reliable. For me, it is going to be maybe the long collar that we talked about a little bit earlier, but definitely the married put position. That's the direct answer of safest and most reliable. I can disappear. This is a far out put to February. I can disappear for 5 months, come back in. If the stock's down 20%, I'm down 8. If the stock's up 20%, I'm still up about 12. And if it just stagnates there, okay, so maybe it stagnates where it is, I'm down 7, 8%. True. But if I'm actively trading it, we can do something along these lines, all right? Side thought, this came up today, this week with my wife. My wife and I talked about adding more things. Do we want to do it this way? Do we want to do that? Do we want to put her name on this account? Do we want to put her name on this? So on and so forth. And the thought occurred to me, and she said, well, what happens if something does happen to you? Let's say that you're not even anything. You're incapacitated in some way. Okay? Always a good decision to make when still under a pandemic, in a sense. How is she going to trade? She doesn't know what I do. You guys do. I could turn it over to you guys and you could trade my account. But she doesn't really know what I do. She has an idea, but she doesn't know. And so she says, well, what would happen if to all those trades you have open, or not, there's not a lot, but all these trades you have open, what would happen if it's just sitting there in that account doing nothing? Not to worry. 50 to 60% of my portfolio is in married put positions. Not to worry. I'm not afraid. The market could drop 50% of its value. I'd be down 6% total on that 50% of my portfolio, or 3% of the total portfolio. I might regret leaving some bull put credit spreads open or a calendar spread, but that's the case. So Rex, the immediate answer is this, okay?